So week 2, super excited. Got a great video chat that I did with someone that I've known for a long time, Liz Murley, about lifetime mortgages. It's a great watch if you are interested in exploring how releasing equity from your property could literally change your life forever and those of your loved ones and your grandchildren or your children and yourselves.
So my name is Liz Murley and I'm a lifetime mortgage specialist, or what you would know as equity release. I've been in financial services over 40 years and came to this sort of sector fairly late in life myself. I retired from my own main career. So what can I do to keep myself occupied? So I've been doing this type of advising for 10 years now. I love the conversation. I love the people that I meet. And it's primarily, same with you, about helping people meet their goals in later life, if you like, by accessing their property wealth. I very often see people 3 or 4 times face to face. This is a very considered decision. It's not a rushed decision. Unless there's a compelling reason to do it quickly, I like to slow it down, give people time to think about it, talk to their family, which is very important, because it did have a poor reputation in the past, and a lot of that came from families finding out when parents had passed away that their parents had done equity release and not informed them, if you like. So we very much encourage the involvement of the family in the decisions now, either via being present at the meeting or via Zooms or emails or those types of things. So that's me.
I mean, that's an important factor on its own, that whole thing of involving the family. So a lot of the conversations that I have with clients is not that they necessarily need equity release today, but they can bring it in as a factor of something that, if their finances don't quite align to how they want to live their life, then what options have they got? And one of those might be at some stage in the future, and often it's 5 or 10 years down the line, it's like saying, well, you could downsize or you could consider equity release. And right here, right now, it doesn't matter which one you do, but you just know that that's likely to be something that you need to do. But often that will be to spend more money on their family. It might be to take the family away on holiday and have those conversations saying, this is why we're doing it. You know, we've calculated our expenditure over our last 30 years, as it were, and that in order so that we can go and do those family holidays, mum and dad are going to pay for those because we want to spend time with you. And we're going to partly justify or fund that through equity release. Now, I keep using the word equity release and I'm very conscious. I shouldn't be, should I?
You can see me flinching, can't you?
I can, yeah. So I shouldn't be, should I? It's lifetime mortgages?
Yeah, so now the descriptor is a lifetime mortgage, which I think fits nicer with your sort of money coach language and things like that. But you're using a lifetime mortgage to release equity in your property. So we try and not talk about equity release if we can, because that's where the poor reputation was many years ago. It wasn't regulated. You didn't have to have advice. The rates were high. You didn't need to involve your family and all of those types of things. So the product has now really changed its coat, if you like, and now become a very good product that I'm very proud of. We now have a trade body called the Equity Release Council. I was a standard board member there for 5 years, and they are very strict standards that anybody in this sector have to adhere to. And a lot of consumer protections now to make the product a much better outcome for clients.
So 2 points on that. One is that my understanding is that now the rules are in place that an individual cannot lose their house. No matter what happens.
Exactly.
So, and that happened back in the 80s, but the perception's still there with some people.
And that's the biggest part of the job, is overcoming the myths and perceptions of the past, because we remember bad things, we don't tend to remember good things. So if I run through the main protection features, if that would help. So every provider and advisor like myself has to offer what they call a no negative equity guarantee. But what that really means is there would never be a chance where a beneficiary would be asked to pay any shortfall if mum or dad pass away and go into care and the property doesn't cover the outstanding balance. So that's one of the biggest sort of protection features. The loan is designed to run until the second person dies or goes into long-term care. But there's a new protection feature where on first death or the first entry to long-term care, the survivor can choose to pay up their lifetime mortgage if they want to without any penalty. So we call that the compassionate window clause. Basically, it's a recognition that you've had a major life event that you probably hadn't planned for and you want to be able to get out of the contract.
Right.
All plans are portable, and what that really means is if you really want to move home, you're not stuck in your home, you can transfer your lifetime mortgage to another property.
Right.
And one of the biggest things that I was personally involved in is now all plans and all providers allow you to pay the interest if you want to on a voluntary basis.
Okay.
So in the past, why it had a poor reputation is the interest was added to the balance. So you were paying interest on interest.
Yeah.
So the loan would grow quite quickly in that regard.
Yeah.
Now, if you have income, you can pay some of the interest, all of the interest, more of the interest, stop and start it, restart it.
Right. Okay.
At any time. So there's now flexible voluntary payments that allow clients to perhaps pay the interest while they're still working.
Yeah.
And then turn the tap off and not pay the interest when they fully retire.
Okay, so that is gold dust.
Absolutely.
And people need to know that.
Yes.
To dispel all of the bad perceptions or the current, or some people's perceptions of that these are a bad thing, selling the family silver, kicking a problem can down the road, that none of that is actually an issue. So that's really, really important. So thank you for sharing that. One thing that I'm thinking, or various things that I'm thinking, because my mind goes off in tangents here, is that therefore if the client has disposable income that they are not spending, then they're increasing the value of their estate and potentially increasing the inheritance tax bill, and therefore it's very sensible to be paying off some of the interest.
I think
does that work?
The main reason why you'd pay the interest is not to suffer compounding growth on the loan balance.
Yeah.
So at today's rates, the loan will double in 10 years if you pay no interest at all.
Yeah.
And that means the equity that the beneficiaries would receive is being eaten away by compound interest.
Yeah.
Now, for some people, if they have no beneficiaries, no children, no husband, no one, they're just leaving their money to the cats and dogs home, well, then don't pay the interest.
Yeah.
Or for some people who are what we would call asset rich, cash poor, and you meet those, I'm sure, who only have a state pension, which is quite common, then you can't pay the interest.
Yeah.
But the idea is you have all of those options and what we call 100% security of tenure. You could never be repossessed with a lifetime mortgage because you're never going to go into arrears because no payments are expected.
So I think actually that inheritance tax angle might not be quite as I first thought. So, but nonetheless, there are issues where it might reduce inheritance tax, but it's not a given.
Well, I think a third of what I do is gifting. So using the property wealth now as opposed to waiting for your children for you to pass away.
Yeah.
So where that helps with inheritance tax is the gifting rules.
Yeah.
So it counts as a potentially exempt transfer for the 7 years.
Yeah.
And more people want to help their children now. There's an element of control in that with gifting because if I gift it now, I can tell them what they can do with it and what they can't do with it.
Yeah.
And a lot of people are living longer and don't want their beneficiaries to wait until they're in their 60s before they inherit. I mean, it's very common for me to see clients in their 70s who still have at least one surviving parent. So there's that consideration as well.
Yeah. So that really is, it's giving the funds to the bank of mum and dad. When the bank of mum and dad might not have some.
It's basically funding the bank of mum and dad if the bank of mum and dad has run out of money or didn't have the cash assets. But the assets are tied up in the property.
But a lot of that is aligned to, and I suppose this is one of the strengths of equity release, is that mum and dad live in their home, which they've curated and built and become very comfortable in for a long, long time. Don't want to move to a 2-bedroom apartment. What do they do with all their furniture and all those sort of issues? This enables them to stay in their home, which at the end of the day is in most cases big enough to entertain their family when they come to visit, and also help their families along the property ladder, whether it be their children or their grandchildren. So, I mean, I see that a lot as well, and I spend a lot of my time with the cash flow modelling, showing how they can afford to help their family members without necessarily impacting their own standard of living.
Yeah.
But that's where the equity, that's where the lifetime mortgage is. It's a habitual thing. I need to learn that. And maybe even in my own mind, sort of realigning the language to releasing equity.
Yeah.
Because that's what I'm talking about as the bigger picture, either through a lifetime mortgage or through downsizing.
Yeah. I mean, downsizing is the purest form of equity release.
Yes.
But today with stamp duty, cost of moving, particularly in this part of the world, people don't want to downsize. And actually, if you go sideways from a house to a bungalow or a flat, you're going to pay almost exactly the same amount of money. So that release of equity is not as effective as it could be. And very often, and this comes up quite a lot again in Dorset, is the families say, oh, I don't want mum and dad to downsize. We like this property. We want it when they pass away. So the good news is the lender on death and long-term care entry doesn't care where their loan is repaid from. So if the children want to retain that property, they can. They just have to find a way of paying off the capital themselves. So if they want a second home by the seaside in Dorset, they just do a remortgage themselves or something like that. So the lender has no ownership of the property. It's just a mortgage.
Well, that's a really important point. And again, I think a bit of a misconception. The lender has no ownership of the property.
Yeah, and that's a very powerful statement that I make. You remain the owner of the property and the equity in it. And if you're a baby boomer, as we are, really all you've done to create that wealth is sit on it. So house price inflation since post-war has, how many dinner parties you attend, I know you do, whether we bought our house for 10,000, it's now worth $500,000. But you've done nothing for that $500,000. You've maintained your property, you've paid the bills. That asset is yours to a certain extent.
But I think also importantly, enjoy the property
and
in that time. So, and that's for a lot of people why they don't want to move. They don't want to entertain moving. And I think another point that you made that was really interesting is the portability. So sometimes people want or need to move for valid reasons. They live a little bit too far away from the doctor's surgery and from the local shop, and bus routes are closing and bank branches are closing and all of those issues. So they could take out equity release and then port that to a new property if they do decide to move halfway through their sort of later life process.
I mean, I was on a call yesterday with one of the lenders, and porting is growing hugely. Which was a bit insightful because it's a benefit and it's a protection feature, but it was insightful to know that people are taking the lender up on it. So there is more porting. I think people's lives change, particularly on the death of the first borrower, if you like. Somebody might want to go live near their grandchildren, or they might want to move to Cornwall or whatever. So porting is on the
move
rise
towards their grandchildren or move away.
Whatever, So, I mean, I sometimes say to clients now, I can't think of a reason or a scenario that we can't cater for. There's another protection feature called a downsizing guarantee, which is yet the final scenario, if you like. So with most lenders, if you've had the plan for 5 years and you won't want to downsize to something that they wouldn't consider lending on, so they won't allow you to transfer it. And I always use a mobile home as an example, because that's obviously not bricks and mortar. Property in Spain, they won't transfer the mortgage to something in Spain. Something of very unique construction that they won't lend on, something like here where you're on the riverbank and it can't be done, then they will allow you to pay the mortgage off without penalty if they will not lend on the property. All right. So that's almost yet another final scenario where you can...
So there sounds like there's a lot more protection in place. We'll come on in a minute to talk about the interest rate element, because that was one of the key areas where these failed back in the 80s when we did have it, I mean, it's such a long time ago now that you mention this to
Yeah.
people and they look glazed at you, but
Yeah.
we lived through this where interest rates went to 15%, I think, on one particular
Everyone
day.
talks about that day.
And we could probably both name the Chancellor at the time, but most of our audience wouldn't have a clue what we're talking about. The interest rates on lifetime mortgages are fixed.
They are.
Okay, so that risk is just completely wiped
Yeah,
off the table.
De-risk the variability.
Yes.
But at the moment, rate, and also what's happened in recent times is rates are more aligned to normal rates, where in the past there was quite a big difference, if you like. But now, say for example, at the moment the best rate I've got is about 6%. Well, in the normal market, rates for 4 or 5 years are about 5%. So that difference has gone away.
Yeah.
But the other good thing is if you want to refinance or remortgage, so say if rates did fall, and I usually say to clients at the moment, you'd want them to fall by half, then we can refinance it to a better rate.
Right.
So you're not stuck forever. You'd have to pay some early penalties, but I would work out that it was worthwhile doing so.
Or not, in which case you stay.
Yeah, but if it's not,
okay,
if it's
so
not financially viable,
that's
I'd
really
talk
interesting as
people
well.
out of it.
I wasn't aware of that.
Yeah.
And that's the thing here. I don't sell or recommend these products.
Yeah.
I signpost to experts.
Yeah.
For reasons like that you've explained, already, things that are like, oh, okay, I wasn't aware of that.
Yeah.
Why would I be? Because it's not a market that I operate in. But I do encourage my clients to at least explore this opportunity or the options.
There's a discussion paper, I don't know if you've seen it, so the regulator, the FCA, have said currently there's a discussion paper that we have to comment on by mid-September. Now they're looking at the later life market, which is what we call it, for opportunities to close so many shortfalls, if you like. Obviously, pension savings is one, long-term care is another, intergenerational gifting, so giving money to the children to get them on the property ladder.
Yeah.
So for the first time, even the regulator and the government is saying we want people to be accessing their property wealth to fix a number of financial shortfalls, which is great for us.
Yes. Well, great for the individual, I think, because I've always referred to this as the client's get out of jail card.
Yeah.
From what you've just said, and I sense that you're going to contest that.
Say that, yes.
But from what you've just said, the government are seeing it as a get out of jail card.
Yes. Well, I've been to many sort of conferences where you have the Minister for Health, the Minister for Pensions, the Minister for Employment, and they all want a slice of the property wealth that's tied up in the UK.
Yeah.
There's £9 trillion worth of property wealth, of which at least a quarter is held by people over 65.
Right.
So they're all going, how can we incentivise people or encourage people to tap into that property wealth?
Yeah.
And the biggest thing that I'm going to say in my pushback to the regulator is reputation. We need the regulator and the government to not promote the product, but to support the product.
Yeah.
Because in the past, the likes of Martin Lewis, for example, and other people have said, this is the last resort. And that's what you get from the regulator is, look at everything else before you consider property wealth. And that's not right. We need, from an advisor's point of view, to sit the property wealth in the mix.
It's a very, very good option if the alternative is that you do not fulfill the ambitions and the life that you want to lead. Yeah. Why are you not going on those holidays that you've always wanted to do when you could afford it? And this is a way of affording it. Yeah. And the alternative is that you don't do this and you carry on living in this nice big house. Big houses need a lot of work, a lot of cleaning, a lot of maintenance, a lot of cost. Yeah. That you then can't afford to go on the holidays and the trips, or spending money on your going out for lunches or whatever it might be with your family and your loved ones. So this is a really positive alternative to that.
Well, I think in the past, promotional things that were done on the TV, if you like, about equity release showed beautiful couples buying a yacht and dancing off into the sunset. Yeah. I promise you I've not done a single case for that. Yeah. So it's always needs-based. Yeah. Always a solution, very often a family solution. Yeah. And there are nice things that you do, of course, camper vans and things like that, but generally you're either helping them create more wealth or income because they've undersaved for their pension.
Yeah.
You're protecting the pension because why would you touch that lump sum? Because that was there for income and it's tax efficient to leave it where it is.
Yeah.
You're helping children with all manner of things.
Yeah.
A growing thing now is adapting properties to stay at home for long-term care.
Yeah.
You know, wet rooms, extra bathrooms if you want a live-in carer, that type of thing.
Yeah.
Paying off existing mortgages.
Yeah.
So a lot of people, you will remember, cashed in their endowments and didn't make a plan to pay off the capital.
Yeah.
So that's probably 20-25% of what I do.
And there's a large number, I don't know what the percentages are, people with interest-only mortgages coming to the end of their fixed rates.
Yeah.
This must be a really good positive solution option to that.
Made no plans to pay off their repayment mortgage with an existing bank.
Yeah.
Actually, it was an interest-only mortgage.
Yeah.
Sorry. And the bank will not extend because mainstream banks have different rules and regulations.
Yeah.
And they have no choice. So they're almost coming to me saying, "Please help me stay in this property."
Yeah.
They know they've made a mistake. They should have done something about it years ago, but that's human nature, isn't it?
Yeah, but we are where we are.
Yeah, we are. Yeah.
And there is a solution.
Yeah, so I've written to them already and said, do not worry, I can, within the figures that you've given me, I will be able to remortgage to a lifetime mortgage. You can stay in your home.
Yeah.
And what a relief that was to them.
Yeah. And I think that's another thing. It's like this is a solution to a lot of problems, and that staying in the home at a time when that must be incredibly stressful for them, expecting to have to sell the property to clear the debt, and then they're looking at what's left and starting to look and see what sort of property they're going to be able to get with. That's a massive disruption to their life. They're moving from a 2 or 3 bedroom house into a 1 bedroom apartment, for example, 10 years before they were expecting that might ever be something they would have to consider. Well, that's pretty soul destroying. Whereas this is a valid and viable alternative to doing that. So that's a really positive
and
thing.
I think if people are still pre-retirement, so still working, because I see a lot, I'm sure you do as well, I see a lot of people 55 plus who perhaps have left their main career, but they're doing something else, but they have not got their state pension yet. It's that gap where they've still got normal debts and mortgages that they haven't quite planned. Or health is another big thing that comes along and takes people's legs off, doesn't it? I hadn't planned for that. So
that can come out of nowhere.
Yeah.
And I think where I see it as well is where you've got with the graphs that my cash flow provide, where you've got those 3 scenarios: more than enough, nowhere near enough, to having enough. If when I'm doing those charts, if I factor in having nowhere near enough, that might be, I was doing an example case yesterday where that actually meant on a chart, it's difficult to replicate on a video and all the rest of it, but on the charts that I use, that might be money to a 60-year-old, that's money running out at 75. Okay, don't go ahead on that basis. That's not a good strategy because you don't know when you're going to die. If we knew when we were going to die, wouldn't financially
make our life a lot easier.
Be a lot easier. But so that's not a good strategy. But if in 10 years' time, we factor into those charts that you will strongly consider, or you actually do, to a lifetime mortgage, for example, that's what gets you from there to there. Now, the real significance, i.e. you're never running out of money and actually, having enough to leave a legacy to your children, that's a massive difference. But if that means that you can retire on the 1st of January, that's the difference. And it's not kicking the can down the road in terms of, we'll just bury our head in the sands and we'll make it's like that's the scenario is based upon those assumptions. And yes, you are going to do equity release in 10 years' time, but that's what's going to enable you to take real action tomorrow, which might be, by the way, retiring on the 1st of January and giving you the income that you want, which you've factored in is enough for you to maybe make some gifts to children, or certainly start planning those holidays and what have you. And certainly a lot of the conversations I have with clients are around phased income in retirement. So if you're going to retire at 60, you are probably going to want and will spend more money between 60 and 75 than you will between 75 and 90. So that scenario lends itself very much to go and have your 5 or 10 years of travel and all the things that you want to do. But then maybe when that stops, then you could restart then paying the interest or some of the interest.
I mean, I call it the wellness years. And I've seen it with my own parents. In post-retirement, they had a great time.
Yeah.
From the age of 80 onwards, they didn't do anything. They just sat in a chair.
Yeah.
And actually their savings went up.
Yeah.
Because they weren't spending any money.
Yeah.
Plus they were getting attendance allowance and things like that
Yeah.
back then. So actually my father died with money, which was kind of odd.
Yeah.
The other thing this product now...
But with amazing memories.
With good memories, yeah. Lifetime mortgages are the only product that you can have a lump sum and a drawdown, which fits quite nicely with your phased idea.
Yeah.
So you can have a lump sum up front and a facility to draw in life. So if you're not fixing a lump sum solution like gifting or whatever, we are going down the drawdown route all the time.
Yeah.
Because you only pay interest on what you've taken.
So you would have your facility to borrow, let's say...
Say it's 100,000.
100,000.
20 up front, 10 grand a year until you stop travelling.
Or and stopping that if you don't need it. Yeah. It's the ability to take 10 grand a year.
If you never touch the facility, you've paid nothing for it.
Right.
So
again, the flexibility.
The only product in financial services that you can have a facility like that, tapping into your property well. And again, drawdown plans are increasing year on year.
Yeah. So a lot of what I do is about realizing what your goals are. And sometimes I have to work quite hard with clients to get them to actually sit down and think about it because why think about something that they don't believe is possible? Well, no, it is possible, and that's my job, is to sort of try and align their finances to their dreams. But I do spend time with them to work out what their dreams and their goals are. Yeah. What if scenarios, and then it's like, well, actually, you know that you could do that. So we are only here once. Yeah. It's madness not to do that. Yeah. So, and this is just a facility to enable people to do that. So I think it's a really powerful.
And if you access your facility, the drawdown is at the rate at the time, the prevailing rate. So let's imagine right now we're in a fairly high rate environment. Okay. But if you have your drawdown plan and you say you draw more money in 5 years' time, if rates have fallen, you will be at the lower rate. Wow. So you end up with a sort of blend of rates, which is much better for you in the long term. Yeah. There is no point, and I do say this to clients, drawing £100,000, putting it in the bank, waste of time. No. Unless you've got a need for £100,000. Okay. So a facility for £100,000, you want to give a big holiday, £10,000. You want to give £5,000 to each of your children to top up their deposit for a property, or grandchildren, or whatever it might be. And you might need that $10,000 a year topping up your income because you've got some other holidays and weddings and so on to pay for. But then you don't need to take it if you don't need it, don't take it. That's right. And that's the only product I can think of in all my 40 plus years that looks like this. Yeah. So it's so flexible and answers so many solutions. Yeah. And so I think I've drawn this little sketch, so I'm going to use it. And I don't know, this probably won't come out in the video, but we could probably sort of superimpose something. This is how I talk to clients about it. Okay. So that is a house. Okay. Sort of. I'm not the best drawer in the world. Let's be fair. And what I say to clients is, okay, I know the number's different. We'll come on and talk about that. But if we assume that you're going to borrow 25% of the value of your property as kind of the starting point, and we come on and talk about percentages and ages and the differences around that. And I'm going to go back to the days when it was at 4% because the maths is easier. Yeah. Okay. And I know that you've already said we're more likely at 6%, and I can do the maths on that. Yeah. But let's do it at 4%. So let's assume that the house is $1 million again because the maths work. Okay. So if you're borrowing 25% of that, you've got 250,000 at 4%. Yeah. Okay. Which, in order to make the scenario work, i.e. that you're not selling the family silver, you need the growth on the whole of the property to go up by 1% per annum. Yeah, you're talking about house price inflation. Yes. Yeah. So the value of the property to go up by 1% per annum for the growth to match the interest that you're paying on the loan. Yeah. And
I don't know what the I do know what the long-term average on house price is. It's around about 4%.
It's better than 1. Yeah.
It's better than 1, and most people recognise that it's never not gone up by at least 1% per annum as an average over a 5-year period. I'm sure there's probably been, there have been years when house prices
there's been the odd years, but
have
if you
gone
look
down,
at
but
any
very
graphs
odd.
that we use, it's,
Yeah.
go back 30 years, house price inflation has been there. We've had
Yeah.
dips, haven't we? It's a bit like shares. It's the same
Yeah,
thing.
no different at all. So
But
ignore the
property
short
wealth
term.
holds water pretty well,
Yeah.
I think.
So that's how I explain it to clients. And then when clients see that, I think, oh, okay.
Yeah.
So then that brings out a couple of points, which I know that, you're the expert on expanding on. My understanding is that the percentage of the value of your property that you could borrow is dictated by your age.
Yeah.
So what's the earliest age that someone could consider equity release?
55.
55.
Yeah.
Okay. So in my mind, I've always thought 65 was
No,
kind of
55.
the earliest.
Yeah.
So at 55, you're going to be able to borrow
20%.
20%.
Yeah.
Right. Okay. And then without going into all the detail, at 60,
Well, basically, I say to people, it goes up 5% a year every 5 years.
so at 60, it's 25%.
that's it, sorry.
65, you're looking at 30%. 70, you're looking at 35%.
That's it.
75, you're looking at 40%.
Yeah. And
Okay.
at 80 plus, we get to about 50%, because the sad thing is the lender is assuming they're going to get their money back a bit quicker.
Yeah. But that's the reality of life.
And these are maximums as well. So what I often do with people say, right, you can borrow that, but do you need to borrow that? Because if you come back a little bit by a couple of percentage points against the value, the rate is much better.
Yeah.
But that's my job to kind of work that out with the client.
So as ballpark figures, those work.
Yeah.
So when I'm looking at implementing that into my cash flow modelling charts, and this is where it becomes so important, because this is where I'm not passing or referring clients to you on a daily basis. But trust me, I'm having these conversations on a daily basis with my clients. It just might not be for another few years. Whereas I sense from what you're saying that the inquiries that you're getting from all of your sources are people that probably are more interested in doing it today.
Today or in the next 12 months, I would
Right,
say.
So
the
more
horizon's
immediate.
normally 12
more
months.
immediate.
Yeah.
But I could see, because actually in this sort of series that I'm recording, the Beyond Money, so earlier in the week I had a conversation with a mortgage broker, and one of the things we were talking about there is this sort of real pain point, which is we're in the period now, and it's certainly, it's not going to go away for a while now, where people's low fixed rate mortgages are coming to an end. Some of that's already happened, and some of that's going to happen over the next sort of 12, 18 months, couple of years. If you're over a certain age, this might be the only alternative.
Yes, there is a lot of innovation now in the market, because when pendulums swing backwards.
Yeah.
So in 2008, no interest only mortgages, no later life lending, no lending into retirement. Got very tight, didn't it?
Yeah.
In a lot of the smaller lenders now, the mainstream lenders, they're looking again at older borrowers and pension income. It only really works if you have income, though, good income, and good pensions.
Yeah.
Some of the products have to work on after first death, the survivor has to have income as well.
Right.
So that's quite hard to come by. A couple who've both got very good occupational pensions or personal pensions.
Yeah.
But there is innovation in the market. One of the lenders is actually looking at a kind of interest-bearing mortgage at 50 that turns naturally into a lifetime mortgage at 60 or 65.
Okay.
So rather than having to redo your plans, if you like, to fit with your money coach role, you have one of these hybrid type products that does you well now, but you must pay the interest in the early years, but you can turn that tap off when you retire.
Right.
So there's a huge amount of innovation, which again is underpinning the desire for growth, which is now coming from the regulator as well as the government, as well as the industry itself.
Yeah.
So the space in 5 years' time is going to look very different to how it looks today, I think.
Yeah. There's so many positive options and reasons why this can help people.
Much better than it was post 2008.
Yeah, absolutely. What's the growth looking like in the market? I mean, I'm imagining that the growth is...
Yeah, I mean, we're still steady growth year on year, 10%, something like that. But I think why I'm excited about the regulator coming on board, because I'm sad like that, and the government, is we need some big hitters, for want of a better word, to be flying the flag.
Yeah.
Because or else we're just picking off either through your type of role or my role or a little, because the TV advertising has gone. I don't know if you noticed that, but there's no TV advertising at the moment because the budgets went, with all the financial things that have been going on recently. So there's no television advertising for equity release right now or lifetime mortgages. Okay. So we need it to come from a different source. We need encouragement through the regulator and what's it called, the money advice service, those types of things.
Where does Martin Lewis sit on this?
He's now on board. Okay. He's a very influential person in the space of financial services, and he's not always right. But anyway.
But people hang on his every word.
Well, because he presents to the consumer, doesn't he? Who watch the television. So he sometimes gets things wrong, not just in my space, pensions, all sorts of things wrong. But I think if we had a world where those types of people, including the UK regulator, including the government and all the access points that people have to talk about finances, support this type of property wealth being used, as opposed to saying, oh, it's very, very dangerous, approach it with caution. You should have all of those things as well, but there's just a tone that needs to change.
But if you come from it from a place that I know that you do and I do, and in fact most people I deal with, and I can think of countless conversations that I've had in the last 24 hours with other advisors in different areas. We all come from it in the same place. What is the most beneficial for the client that is going to help them and have an impact on the way that they live their life? And that, as you've said rightly so, it's not all about just going off and going mad and booking loads of holidays and cruises. It's helping them just to live their life, pay their bills and just have a nicer life, or help their family to navigate through what is a difficult time financially and economically.
And interestingly, a new thing for me in the last 12 months has been private healthcare. So people coming to me and saying, I can't wait for a new hip on the NHS. Can I borrow £10,000 to have a new hip? So I've probably done half a dozen cases in a basket of things that you're trying to achieve. I'm going to set aside money for a new hip, new knee, new shoulder, whatever it happens to be, because I don't want to wait in pain on the NHS waiting list.
So something that's just really sprung into my head, and whether this will work or not, and if it's valid, we'll leave it in, and if it's not, we'll cut it out. But it's almost like saying to someone, if you had £100,000,
what would you do with it?
You won £100,000 on the lottery, what would you do with it? And it's like, right, well, my wife really does need a new hip. The kids could do with a bit of a help. One of them's getting married next year. One of them's, just moving house. We'd like to give them a bit of money. I've had enough. I really want to sort of slow down now and stop working or whatever. So we'd revisit what that looks like. And part of that would be, we want to go on a really nice holiday. We've always wanted to go to Japan. Let's make that happen. And then let's take all the kids away. That sort of thing. It's almost like sort of like fantasizing around what you would do with £100,000. But if there's all of that good that comes out of that, and some nice things as well that you don't, they're wants, not needs, but there's some needs in there as well. Well, why wouldn't you do that?
Well, it's kind of why not. But I think, our role, because you've done my role, is to look at a client's total wealth, isn't it? And say, well, but this bit of wealth that you've got, that's going to deliver you an income in retirement. That's your pension wealth. You can take your tax-free cash by all means. But by doing so, you're actually reducing your income, aren't you, by doing that? You've got, I don't know, I'm going to say something like £20,000 in a tax-free savings account. Generally speaking, that's your emergency fund.
That's your safety net.
The car breaks down, I need a new washing machine or whatever. But they don't generally have money for the dreams, if you like. And that's where but they have property wealth. So that's where this comes into it.
So you can have the best of both worlds, but in a sensible, informed and viable way, rather than just borrowing 100 or putting 100, well, you wouldn't put 100 grand on a credit card, but rather than just sort of I'll sod it, we're going to go to Japan, we've always wanted to do it and we'll worry about that in the future, sort of thing. It's a more sensible, viable way of doing that.
Thankfully, and there's no plans to change this, you cannot buy a lifetime mortgage yourself online. And I would be dead against that anyway if that was. So you have to have advice from someone like me who's got the qualifications and experience. And I do sometimes say to people, no, it's not the right solution for you.
Because you review their circumstances, and you can say, well, actually, you've got money over there that you're not touching. You don't need £200,000 as a cash reserve.
No, that's right.
Have you thought about
and then
spending some
come back
of
and
that?
talk to me? And I'm very happy to just say to people, no, it's not appropriate right now.
But that's where my cash flow modelling comes in, because I'm having conversations all the time with clients about this, but it's not, you don't need to do it now. Because so they might be 55 or 60, and it's like, in order for you to retire on the 1st of January next year, and then people's eyes light up, it's like, oh, is that even possible? Yes, it is, but we have to factor in, your money's going to run out at 75, but if you do equity release at 70, your money will last forever.
One of the things you could do early in your process is check the property out with me. Okay. This is a property transaction for the lenders.
Yes.
So before you oversell your dream, let me check that the property would be suitable. And I can tell you that in a heartbeat.
Okay.
I've been doing this
so
for so long.
What is not acceptable?
There's some properties on Christchurch Quay. Can't be done. Tried.
Because of flood?
Yeah, because flood risk. So anything that's close to water, just be careful.
Okay.
Flats in Bournemouth Town Centre over 10 stories. Lenders don't like them.
Okay.
That kind of thing. Anything right next to a commercial premises. So either over a chip shop or next to a motorway and next to a massive Tesco's.
Okay.
Because the lenders can afford to be choosy, you see. So they're building a property portfolio. Yeah. So I'm always quite cautious with people selling the dream of lifetime mortgages and then me saying, oh, it just can't be done.
Yeah.
A windmill, lots of thatching in the property that hasn't been replaced. The lenders are getting a lot better.
Okay.
And the criteria is getting more and more properties into the acceptability standards, if you like.
Right.
But I always say to people, please run the property past me.
Okay.
And
well, that
that kind of thing.
That is really powerful.
It's like a word of caution to you.
Yeah, no, but I think that's really, really important.
Yeah. Mainly, if you think about it, it's the resaleability later on in life that the lenders worry about. Yeah. Because it's quite unique. So if it's unique, it's in fact they hate retirement homes for the same reason. Yeah. So anything that's over 55 can only be lived in by somebody over 55. Yeah. The lenders in my space don't like them.
Restricts
because
the
you're
resale.
restricting the market for resale.
So, and again, coming back to your point where the lender does not have any ownership of the property, but they have to sensibly keep an eye on, could that property be sold? Yes. Let's take it to its extreme circumstance when the purchaser or the borrower passes away, and then the children or the executors cannot sell that property. That causes a problem back to the lender. So the
lender gives all the beneficiaries 12 months post second death to sell the property. So the family are given quite a bit of time to make that decision, because the lender doesn't want to be reputationally seen as coming in and sort of disturbing them too much in a moment of distress and grief. So the family have 12 months to make the decision. But I know lenders will then start to get interested after 12. What are you doing? Who are you marketing it with? How many viewings have you had? That kind of thing. I mean, they're still charging interest, so
Yeah, but they're keener to get the debt repaid.
Yeah.
But interestingly, because I'm very aware of this from clients' situations, that's 6 months longer than the government give to pay the inheritance.
Yeah, that's right.
Yeah. So
I mean, I've given you a little shopping list, so you could probably I can walk into a property straight away and go, nope.
Right.
Yeah, and I can.
Well, that's because you specialise.
Yes. Yeah, I've been doing it so long. I drive around my area going, not that one.
Yeah. I mean, there's been so many nuggets that I've not previously thought about. So, but it doesn't change. Nothing has changed. I still think it's a very, very valid proposition and option for a client to consider. Yeah. And the closer they get to making decisions around it, the more that they should look into it and have that conversation with you as the expert Even if I can see that, even if it's something that they're not going to do for another 5 years.
And I would encourage you to refer them to me even if they're not ready, because my time is free. Nobody pays me any upfront costs. So I really
just
don't
a
mind
chat,
having a cup of tea,
get them in the system.
You know, sit them down, just answer all their questions, all their concerns.
But they might want to accelerate the process.
Well, they might. But,
because it's like, well, actually, why are we waiting 5 years? Let's do it now and give some money away to the kids or the grandkids.
Because the only time I can absolutely guarantee it is when the lender of choice, or a couple of lenders I might have chosen, values the property, because it's an independent valuation that's paid for by the lender. So there's no upfront costs either to get to that point. And then I can say to clients, you've got your, you know, guarantee that it can be done.
So it's almost like in principle, this is what you could borrow.
Like, but remember, when you're talking to people, this, for the lender, it's a property transaction.
Yeah.
They're not interested in Mr. and Mrs. Smith. You are, I am.
Yeah.
They're only interested in the property.
Yeah. Bricks and mortar, what's the value?
Yeah, it's a balance sheet thing. They're offsetting their pension funds with a different asset class. That's it.
So I suppose that's where a realistic valuation on the property.
Yeah, and I do say that to people as well. This is a valuation for mortgage purposes. So very often not what they would get the 3 estate agents telling them it's what it's worth.
Yeah, yeah. Interesting. But incredible. Really, really valuable conversation. So I can't thank you enough.
You're welcome.
It's been brilliant. Thank you.
Good.